The Federal Reserve just told you something extremely important, not in a press conference, not in a speech by Jerome Powell, not in any official announcement designed to capture headlines. They told you in the quiet, behind-the-scenes language of meeting minutes, the kind of document that most Americans will never read and that financial media will summarize in a single paragraph before moving on to the next story. But what those minutes revealed is far more significant than any single headline suggests. The Federal Reserve is divided, not just mildly, not just philosophically, but fundamentally about the most important question facing the American economy right now. What do we do about interest rates? I am Kenzo John AG, and this is Market Acme. And today I want to walk you through exactly what happened in that Federal Reserve meeting, why it matters so much more than the mainstream financial media is telling you, and what it means for your money, your savings, and your ability to navigate what is increasingly looking like a period of sustained financial instability that nobody in Washington seems prepared to address honestly. Let me start with what the minutes actually said because the language matters. The Federal Reserve's latest meeting minutes showed policymakers were split on the path for U.S. rates, suggesting that the next chairman, the person who takes over when Jerome Powell's term ends in May, could face extraordinary challenges in implementing any rate cuts at all. Let me read that again. The next Federal Reserve chairman could face challenges in implementing rate cuts. That is not a minor observation. That is a structural acknowledgement that the most powerful central bank in the world is not aligned on the most consequential decision it makes, which is how much it costs to borrow money. But it gets more significant. Several participants in that Federal Reserve meeting favored language that would have explicitly left open the option of raising the federal funds rate should inflation remain above target. Let me translate that into plain English. Some of the people who set interest rates wanted American to make sure everyone understood that they have not ruled out raising rates even higher. Not a small increase, not an adjustment, but an actual return to rate hikes after a period of cuts that markets have been eagerly anticipating, and these were not fringe participants. These were voting members of the Federal Open Market Committee, the group that actually decides what happens to interest rates. If this sounds like the Federal Reserve is sending mixed signals, you are right. But the mixed signal is actually the story. Because on one hand, the Fed has been signaling for months that it intends to cut rates. On the other hand, the minutes from their most recent meeting reveal that several officials are not just skeptical of cutting, but open to raising rates if inflation does not cooperate. That is not a unified message. That is a central bank that is genuinely uncertain about where the economy is headed and is trying to keep every option open at the same time. Now here is why this matters for your money. The entire investment thesis that has been driving markets for the past year and a half has been built on the assumption that interest rates would keep going down. Not dramatically, not to zero again, but lower than they are now. The expectation built into asset prices across stocks, bonds, real estate, and crypto has been that the Federal Reserve would continue cutting rates through 2025 and beyond, making borrowing cheaper, making cash less attractive, and pushing investors into riskier assets in search of yield. Every major rally in every market over the past 12 months has been built on that foundation. What happens when that foundation starts to crack? What happens when the central bank that was supposed to be your biggest ally in the markets suddenly signals that it might not cut rates at all? What happens when the most liquid currency in the world, the US dollar, starts strengthening precisely because investors are repricing the likelihood of rate cuts out of the equation? That is exactly what we are watching happen right now. And it is happening faster than most people realize. The dollar index hovered around 97.7 on Thursday after surging in the previous session. That might not sound dramatic to you. It might sound like a number that belongs in the world of currency traders and macroeconomists, not in your daily financial life. But let me explain why that number matters enormously to you whether you own a single dollar or not. The dollar index measures the value of the US dollar against a basket of foreign currencies. When the dollar index goes up, the dollar is getting stronger relative to other currencies. When it goes down, the dollar is weakening. What we are seeing right now is the dollar holding gains at over 1-week highs. That means the dollar is getting stronger, and a stronger dollar has direct consequences for almost everything in your financial life. Start with imports. Almost everything you buy that is manufactured abroad, from electronics to clothing to household goods, becomes more expensive when the dollar strengthens. That is because foreign sellers want to maintain their margins in their own currencies. When the dollar is strong, they can charge the same foreign currency price and it translates to more dollars for them. So they raise prices in dollar terms to capture that advantage. Your groceries, your electronics, your clothing, all of it gets more expensive not because of inflation in the traditional sense, but because of currency movements that you cannot see and do not control. Then think about travel. If you have ever planned a vacation abroad, you know how currency exchange works. When the dollar is strong, your vacation becomes cheaper in relative terms. You get more foreign currency for every dollar you spend. When the dollar weakens, your vacation becomes more expensive. What the Federal Reserve is signaling right now, with its hawkish division and its reluctance to cut rates, is actually strengthening the dollar in the short term. But that strength is a double-edged sword. It makes imports cheaper in one sense and more expensive in another. It attracts foreign capital looking for yield, but it also makes American exports more expensive to foreign buyers, which can hurt American companies that sell overseas. And then there is the interest rate connection. When the Federal Reserve keeps rates higher for longer, it makes dollar-denominated assets more attractive to foreign investors. They can earn higher yields on their U.S. investments than they can on investments in their own currencies. That inflow of foreign capital strengthens the dollar further. But it also means that when you borrow money, whether it is a mortgage, a car loan, or a business loan, you are borrowing in a currency that is becoming more expensive to repay. The math on your debt changes not because your income changed, but because the Federal Reserve decided to keep rates higher than expected. Now let me talk about what the Federal Reserve minutes revealed about the internal debate, because this is where it gets really interesting for anyone trying to understand where this economy is headed. The minutes showed that policymakers were split on where to take U.S. rates. Not slightly, not politely, but fundamentally divided about the most important decision they make. And the minutes suggested that the next chairman, whoever that turns out to be, will have a hard time pushing through rate cuts. That is an extraordinary statement from an institution that is supposed to operate with consensus and clarity. Think about what this means. The Federal Reserve, the most powerful central bank in the world, is essentially admitting that it cannot guarantee a smooth path toward lower interest rates. The person who takes over in May when Jerome Powell's term ends will inherit an institution that is fighting internally about whether to cut rates, raise rates, or hold rates steady. That is not a stable environment for markets. That is not a predictable environment for businesses planning investment. And it is certainly not a comfortable environment for ordinary Americans trying to figure out whether to lock in a mortgage rate now or wait for rates to drop later. Several policymakers are expecting productivity gains to dampen inflation. That is the optimistic scenario. If American workers become dramatically more productive, they can produce more output per hour worked, which means companies can raise wages without raising prices, which means inflation comes down without the Federal Reserve having to crush the economy through high interest rates. That is the theory. But the minutes also said that most participants cautioned progress may be slow and uneven. In other words, do not count on productivity saving us. Several officials went further and indicated that rate hikes are possible if inflation stays above target. Not probable, not likely, possible. And that possibility is enough to keep markets on edge. Now I want to connect this to the broader picture because the Federal Reserve Division is not happening in a vacuum. It is happening at the same time as a dozen other macroeconomic stresses that are all pushing in different directions. And understanding how those stresses interact is the key to understanding why your financial life is about to get more complicated. Let me start with what is happening in Asia because the currency movements there are directly connected to what the Federal Reserve is doing. The Japanese yen took a knock on the stronger dollar overnight. It was down 1% against the dollar and holding at 154.78. That is a retreat from the 152 level that it had tested last week. And the interesting part is not just the number, the interesting part is why it is happening. The Trump administration announced projects valued at $36 billion as the first investments under Japan's promised $550 billion U.S. investment pledge. That is supposed to be good for the U.S. economy. More foreign investment means more jobs, more construction, more economic activity. But what it also means is that Japanese capital is flowing into U.S. dollar-denominated assets, which strengthens the dollar further and weakens the yen further. Here is the dynamic that currency traders are watching very closely. Japan has been investing heavily in the United States. That investment is denominated in dollars. But Japan also holds massive foreign exchange reserves, the largest in the world after China. The question facing currency markets this year is whether Japanese investment into the U.S. provides supportive dollar flow, or whether Japan uses its foreign exchange reserves to guarantee new dollar loans and avoid pressure on the yen. The latter seems to be the preferred outcome for Tokyo. In other words, Japan may be quietly defending the yen by using its reserves rather than letting the currency collapse completely. But that defense has limits, and when those limits are reached, the yen could fall much further than anyone expects. Chris Turner, global head of research at ING, put it this way: direct Japanese investment into the U.S. will be a key watch factor this year, and one which adds to the very mixed picture on USD JPY. The question for FX markets this year is whether this investment proves a supportive dollar flow or something like Japan's FX reserves are used to guarantee new USD loans and avoid pressure on the yen. That is a polite way of saying that Japan is trying to manage a currency crisis in slow motion, and the outcome is far from certain. Now let me move to Australia, because the Australian dollar is telling an interesting story that connects directly to the Federal Reserve dynamics. The Aussie dollar held at 0.7045 after employment data showed the jobless rate stayed at multi-month lows of 4.1%. That is remarkably low unemployment, and it is giving the Reserve Bank of Australia room to raise interest rates rather than cut them. The RBA raised its cash rate earlier this month, citing persistent inflation and resilient jobs conditions. And markets continue to price more rate hikes from the RBA this year. That is important because it creates a divergence between Australian interest rates and American interest rates. When the Federal Reserve is signaling it might not cut rates, or might even raise them, the RBA is actually raising rates. That makes Australian dollar-denominated assets relatively more attractive than they would be if both central banks were moving in the same direction. The Australian dollar gained 0.2% after that employment data, bucking the trend of weakness across Asian currencies. That is not a small movement in the context of currency markets. It represents billions of dollars of capital flows and reflects a fundamental shift in how investors think about yield. When American rates stay high and Australian rates rise, the carry trade shifts in favor of the Aussie. More investors borrow in low-interest currencies like the yen and invest in high-interest currencies like the Australian dollar. That is exactly the kind of dynamic that can create enormous volatility when it reverses. And then there is New Zealand. The New Zealand dollar was smarting, having notched its steepest percentage drop since last April's tariff blitz, after the central bank took a cautious line about future interest rate hikes, undershooting market expectations. The Kiwi dropped nearly 1.4% overnight and was just under 0.60 in morning trade. That is a massive single-day drop for a major currency. And it happened because the Reserve Bank of New Zealand signaled that it was not going to raise rates as aggressively as markets expected. When a central bank disappoints market expectations on rates, the currency sells off. And what that tells you is that currency markets are currently sensitive to any signal about where interest rates are headed. The market has been pricing in aggressive rate cuts from central banks around the world. When a central bank deviates from that script, even slightly, the currency gets hammered. Now, I want to bring this back to the United States because what is happening globally is a direct consequence of what the Federal Reserve is doing and not doing. The US dollar was off recent lows, and hanging on to a bounce after minutes from the Federal Reserve showed policymakers did not seem to be in a rush to cut interest rates, and that several were open to hikes if inflation proved sticky. That is the key sentence. The dollar is bouncing precisely because the Federal Reserve is not promising to cut rates. Every time the Fed signals caution about cutting, the dollar strengthens. Every time markets price out a rate cut, Treasury yields rise. And every time Treasury yields rise, every other interest rate in the economy follows. U.S. yields were higher, and the dollar's overnight gains against the euro and yen were consolidated in early trade in Asia, holding the euro below 1.18. The euro hovered at 1.1788, having also taken a knock on a report that European Central Bank President Christine Lagarde plans to leave before her term ends in October next year. Think about that for a moment. The European Central Bank is potentially losing its leader at a time when the European economy is struggling and the euro is weakening against the dollar. That is not a coincidence. That is a structural vulnerability, and it is exactly the kind of vulnerability that the Federal Reserve's division is exposing. Sterling sat at 1.3497, holding its own but not gaining significant ground against a strengthening dollar. The British pound has its own challenges, from post-Brexit economic dysfunction to political uncertainty, and it cannot afford to weaken much further without triggering inflation concerns of its own. But against a dollar that is strengthening on Fed hawkishness, even stable is a form of weakness. Now I want to talk about gold, because gold is telling its own story in the middle of all this currency volatility. Gold steadied in thin trade as investors awaited U.S. inflation data. Spot gold was steady at 4,180.60 per ounce after rising more than 2% a day earlier. Let me break down what is happening with gold and why it matters for your portfolio. Gold is in a consolidation mood, reflective of thin liquidity conditions during the Asia holiday period, rather than a shift in fundamentals. That is what Christopher Wong, a strategist at OCBC, said, and that is an important observation. Gold is not falling because fundamentals have changed. It is consolidating because trading volumes are thin due to Lunar New Year holidays across much of Asia. Mainland Chinese, Hong Kong, Singapore, Taiwan, and South Korea markets were closed. When trading volumes are low, price movements become more volatile in both directions, but the underlying fundamentals that drive gold remain supportive. The US dollar held steady at a more than 1 week high, making greenback-priced bullion more expensive for other currency holders. That should be negative for gold. When the dollar strengthens, gold becomes more expensive for people holding other currencies, which reduces demand, which should push prices down. But gold held steady. That tells you something important. There is deep underlying demand for gold that is not being deterred by dollar strength. Investors are holding on to gold positions because they are worried about something more significant than short-term dollar fluctuations. Meanwhile, January's Fed minutes showed that policymakers were in near unanimous agreement to keep interest rates on hold at their meeting, but remained split over their next steps, with several open to rate hikes if inflation remains elevated, others inclined to support further cuts if inflation recedes. This is exactly the division I described earlier, and it is exactly the kind of uncertainty that drives investors toward hard assets like gold. When central banks cannot agree on what to do with interest rates, when the economic outlook is unclear, when the fiscal situation is deteriorating, investors seek safety in assets that cannot be printed, cannot be devalued by monetary policy, and have held value for thousands of years. Non-yielding bullion tends to do well in low interest rate environments. That is the historical pattern. When interest rates are low, gold becomes more attractive because you are not sacrificing yield by holding it. When interest rates are high, gold becomes less attractive because you could be earning 4 or 5% on treasury bonds instead. But here is the nuance that matters. The Federal Reserve is signaling that it might not cut rates as aggressively as expected. That should be negative for gold. But the underlying fiscal situation, the $64 trillion in debt we discussed in our last video, the unsustainable deficits, the political dysfunction in Washington, all of that supports gold over the longer term. The question is whether the short-term headwinds from a stronger dollar overcome the long-term tailwinds from fiscal deterioration, and the answer is that they probably will for a while, but not forever. We still see a period of consolidation in the near term before prices of gold and silver trend higher gradually. For silver, consolidation is likely to hold in the 70 to 90 range, while gold may trade in the 4,800 to 5I100 range in the interim. That is Christopher Wong's forecast. And it is a reasonable assessment. Gold is likely to trade in a range for now, with the upper bound around 5,100 and the lower bound around 4,800. But the direction of travel over the next 12 to 18 months is likely higher, not lower, because the fundamental forces driving gold, fiscal unsustainability, currency debasement concerns, central bank uncertainty, geopolitical risk, none of those are going away. They are intensifying. Spot silver rose 0.7% to 77.71 per ounce after rising more than 5% on Wednesday. Silver is even more volatile than gold, which means it can deliver bigger gains and bigger losses in shorter time frames. But the same fundamental drivers apply. Silver is both an industrial metal and a monetary metal. When the economy is strong, industrial demand supports silver prices. When the economy is weak and monetary policy becomes accommodative, investors buy silver as a monetary hedge. Right now, we are in a strange middle ground where the economy is neither strongly growing nor clearly in recession, and monetary policy is neither clearly accommodative nor clearly restrictive. That ambiguity is exactly what drives metals sideways until something breaks. Now I want to bring all of this together and explain why the Federal Reserve's division matters so much more than the headlines suggest. Because here is what is really happening. The Federal Reserve is facing a set of constraints that are fundamentally incompatible with the expectations markets have built in. On one hand, the federal debt is heading toward $64 trillion by 2036. Interest payments on that debt are heading toward $2.1 trillion annually. The government needs to refinance massive amounts of Treasury debt, and it needs to do so in an environment where foreign demand for Treasuries is declining. The Federal Reserve historically would step in to support the Treasury market by purchasing bonds with newly printed money. That is quantitative easing. That is the mechanism through which the Fed has supported debt-fueled government spending in the past. On the other hand, inflation is still above the Federal Reserve's 2% target. Not dramatically above, but above. And the labor market remains resilient. Unemployment is low. Wages are rising. Consumer spending is holding up. In a normal economic environment, that would be good news. But in the current environment, it means the Federal Reserve cannot justify aggressive rate cuts because doing so might rekindle inflation. The Fed is stuck between a fiscal rock and a monetary hard place. If the Fed cuts rates aggressively, it risks reigniting inflation at a time when inflation is already proving sticky. If the Fed keeps rates high, it risks crashing the economy and making the debt situation even worse through reduced tax revenues and increased emergency spending. If the Fed does nothing, the Treasury market has to absorb huge amounts of new debt without central bank support, which pushes yields higher, which increases the interest burden on the government, which makes the debt situation worse. There is no good option. That is why the Federal Reserve is divided. That is why they cannot agree on a path forward, because every path forward has enormous costs and no clear benefits. And this is where the implications for your money become concrete. The Federal Reserve's division means interest rate volatility will increase. The days of predictable gradual rate cuts are probably over, at least for now. The days of rate hike uncertainty are back. That means the yield you can earn on savings will fluctuate more than it has in recent memory. That means the mortgage rate you lock in today might look very different from the rate you could have gotten last month or might get next month. That means the stock market will continue experiencing the kind of volatility we have seen over the past several quarters, where every Federal Reserve statement moves markets dramatically in both directions. Asian currencies fell on Thursday, led by the South Korean won and Indian rupee, as a stronger U.S. dollar and hawkish signals from Federal Reserve policymakers weighed on regional units. That is the global ripple effect of Federal Reserve division. When the Fed signals it is not cutting rates, capital flows out of Asian currencies and into dollar-denominated assets. The South Korean won's USD-KRW pair jumped 0.6%. The Indian rupee's USD-INR gained 0.4%. The Chinese yuan's offshore pair USD-CNH edged up 0.2%. Every Asian currency is weakening against a dollar that is strengthening on Federal Reserve hawkishness, and that weakening has real consequences for the economies of those countries. It makes their imports more expensive. It makes their debt service burdens higher. It creates inflation pressures that their central banks have to respond to. The regional currencies also faced headwinds from subdued liquidity, with trading volumes thin across parts of Asia due to Lunar New Year holidays in several markets. But the thin liquidity is not the cause of the weakness. The cause is the Federal Reserve's signal that it is not cutting rates as aggressively as expected. Thin liquidity just amplifies the move. When markets fully reopen after the holiday period, the pressure on Asian currencies could intensify rather than diminish. Now let me talk about what you should be watching for in the coming weeks and months, because this situation is evolving rapidly and the signals are becoming clearer by the day. First, watch the PCE data. The Personal Consumption Expenditures Report is the Federal Reserve's preferred inflation metric. It is due on Friday, as the markets were processing the Fed minutes. If PCE comes in hot, above expectations, the Federal Reserve's hawkish division will be validated. Several officials said they are open to rate hikes if inflation remains elevated. A hot PCE number will make that option more likely. If PCE comes in cool, below expectations, it will strengthen the hand of officials who want to cut rates. But given the current trajectory, a cool number is less likely than a hot number. Inflation has been sticky. It has not been coming down as quickly as the Fed expected, and the labor market remains tight. That combination suggests upward pressure on prices is not going away anytime soon. Second, watch the weekly jobless claims. They are due later today. If jobless claims remain low, it reinforces the narrative of a resilient labor market, which supports the case for keeping rates high. If jobless claims spike, it would signal economic weakness, which would strengthen the case for rate cuts. The labor market is the fulcrum on which the entire interest rate debate pivots. Every employment data point matters. Third, watch the GDP data due on Friday. Markets are looking ahead to U.S. gross domestic product data for clearer direction on the rate path. If GDP comes in strong above expectations, it gives the Federal Reserve more room to keep rates high because the economy is handling higher rates just fine. If GDP comes in weak below expectations, it increases pressure on the Fed to cut rates to stimulate growth. The current consensus is probably somewhere in the middle, but the direction of the surprise matters more than the actual number. Fourth, watch Treasury yields. U.S. yields were higher following the Fed minutes release. That is the market repricing rate cut expectations. If yields continue rising, it will put pressure on stocks, particularly growth stocks, which are more sensitive to interest rates. If yields stabilize or decline, it will be a relief rally for equities. But given the fiscal situation, with the government needing to issue enormous amounts of new Treasury debt, yields are more likely to trend higher than lower over the medium term. Fifth, watch the next Federal Reserve Chairman appointment. The minutes explicitly mentioned that the next chairman, due to start in May, will have a hard time pushing through rate cuts. Whoever is appointed will inherit a deeply divided committee and an economy that is not cooperating with anyone's preferred policy path. The market will be watching very closely for signals about who the next chairman will be and what their philosophy on interest rates is likely to be. Now, I want to bring this down to your level because all of this macro analysis only matters insofar as it helps you make better decisions about your own financial life. Here is what the Federal Reserve's division means for you. The question is not whether the Federal Reserve will cut rates or raise rates. The question is whether they will be able to maintain any coherent policy at all as the fiscal situation deteriorates and the political system remains incapable of addressing it. That is the story that matters. That is the story we are going to keep covering. And that is the story you need to understand if you want to protect your financial future in an environment where the people in charge are divided about the most important decision they face. Subscribe to Market Acme so you do not miss the next episode, because this situation is developing fast. And the decisions the Federal Reserve makes in the coming weeks and the decisions you make about your own financial position in response will determine whether you navigate this period successfully or get caught in the crossfire of a monetary policy crisis that nobody saw coming, but that the warning signs have been pointing toward for years. The Fed is divided. The dollar is strengthening, the yen is collapsing, and the currency war has only just begun. Pay attention, because the next move could come from anywhere, and it could change everything.